Hey everyone, in this video I've got two up-and-coming AI stocks to compare. Now if you're an investor looking to get in on the artificial intelligence trend, it's not too late. 2023 was an excellent year for artificial intelligence stocks. 2024 is likely to be more of the same. I'm going to share with you in this video why I think the AI trend is only getting started and which one of these two stocks is the better AI stock to buy to benefit from that trend. So come along and let's look at these two stocks.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the total addressable market for artificial intelligence over the next several years. According to Statista, the total addressable market for artificial intelligence is expected to grow to $1.85 trillion by the year 2030. That would be up significantly from the $207.9 billion in 2023. Artificial intelligence is popularized by large language models like ChatGPT, but there are more applications like driverless car technology, recommender systems, and more. The companies that stand to benefit from the growth in this AI surge is companies like Amazon, Nvidia, Alphabet, Microsoft, and more. Investors getting in today could realize the exponential returns from investments that capitalize on the growing effectiveness of artificial intelligence. So now you could see that 2023 wasn't a fluke. AI is just getting started. The next decade is going to be incredible for artificial intelligence and companies that are offering AI services. Two such companies are Upstart and C3.ai. Now let's look at their revenue over the last few years. Upstart, you can see, exploded on the scene in 2021 and its revenue has declined. Remember, Upstart offers lending services where the decisions are made by AI instead of traditional lending models where they look at your credit scores. That's an interesting model. If it's proven to be more effective, then Upstart could have a massive market opportunity ahead of itself. Meanwhile, C3.ai offers enterprises and institutions software that helps improve their business performance using artificial intelligence. It too has a great market opportunity. Its revenue has grown to $284 million in the trailing 12 months. Unfortunately, both of these AI stocks are losing money on the bottom line and the trend is worsening. Upstart lost $253 million in the bottom line in the trailing 12 months. C3.ai lost $262 million. The bad news is that the trend is going downward. I often say I don't mind growth companies losing money on the bottom line if they're demonstrating improvement, if they're making progress towards profitability. These two AI stocks are not making progress towards profitability, and that's unfortunate because they have significantly interesting services to offer. The problem is they're having difficulty offering those services at a cost low enough to generate profitability on the bottom line. The good news is that it's still early days and they may yet figure this out and start generating profit. Upstart has already demonstrated that it can generate profit, that this business is proven that it can be profitable. If you look back in 2021 and 2022, it was generating strong profitability and that was increasing north of 150 million net income at one point in 2022. That was before the Federal Reserve started increasing interest rates and its lending performance decreased. But it did prove to investors that under certain circumstances, it can generate strong profitability. So the next metric I wanted to compare these two on is cash flow from operations. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, Two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of percent annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. So now that you know how cash flow from operations works, you can see Upstart is worse than C3.ai in this metric, negative 269.66 million. Although they did make progress on this front, C3.ai meanwhile also negative 69.5 million, but a more stable trend. At least it's not worsening. So again, two growth companies investing in this innovative technology in an area that's expected to grow magnificently over the next several years. So we can slightly look past these losses on the bottom line and give them the benefit of the doubt because they're offering such innovative services that are expected to be so highly in demand over the next few years. Still, it is risky investing in stocks like these that are losing so much money on the bottom line. So finally, I wanted to compare these two AI stocks on valuation, and the metrics I chose to use are the forward price to sales ratio. And looking at this, you can see C3.ai is more than twice as expensive as Upstart, trading at a forward price to sales of 8.29 compared to Upstart trading at a forward price to sales of 3.470. So if I was to choose one of these two AI stocks to buy today, I would choose Upstart. The significantly lower valuation combined with the fact that it already proved that its business can be profitable under certain circumstances leads me to Upstart if I was to pick one of these two AI stocks to buy today. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.